Greetings, Keith Prather here with the NCM RV economic update. Let me go ahead and share my screen real fast. It's going to be an interesting and volatile month, as you can tell. At the time we were recording, we had not gotten the decisions yet on the reciprocal tariffs. That's coming, and I'll talk about tariffs here in a few minutes. But looking at the RV demand index this month, a couple things kind of stand out. Number one, it still looks like we are still going to be trending kind of in a normal pattern, a little more normal than what we saw obviously during the pandemic. It's going to feel a little more like what we had prior to the pandemic and more of a normalized kind of environment. Now, there are some things that I think could really send us in the other direction. I think things could change. But right now, trending just a little bit below the long-term trend. We were about 0.7% month over month lower, which is nothing. It's not a big change. We're still trending about 4.1% higher than last year, which is kind of a good signal. I was down in this period. So index is fairly steady. I think that means probably pretty good things for the industry overall. Let me kick over here. Now the retail sales index, what we're watching is again a little more acceleration. We saw it a little bit higher both month over month and year over year, almost 10% higher than where it was a year ago. Now, February in 24 was a down month. But we have a little bit of a surge here. Could be some folks trying to get ahead of tariffs and the risk of tariff impacts. Could be some dealer incentives, could be a lot of different things. We want to see this trend out a couple more months to see if it really is truly brand new spending or what exactly it is. But we've got some interesting things in the mix that I think are worth talking about. But first, let's talk about Q1 GDP. Obviously, what happens with the RV industry is going to largely depend on a couple different things, but primarily what happens with the macroeconomic environment. And right now there's a lot of news, a lot of chatter out in the marketplace about a recession and worries of a recession. And I showed you this last month. Remember that the primary objective of the Trump administration is to try and get government spending down from 18% of GDP down into and shift that spending down into residential investment and non-residential investment. So individuals, corporations spending more money. And they'd like to see these ratios get to where this is about 10 to 12% of GDP. And then on the non-residential side, try to get that up to about 10% of GDP. So all this shifting of government spending, and you see the DOGE efforts, all of that kind of moving down in and creating incentives for corporations to expand and grow, to invest in manufacturing facilities and construction. All of that is part of this transition and part of this shift. The challenge is, as you all know, is just that period, that lag time between the transition and making that move, and that can be a little painful. So that's what we're seeing in Q1. So this is the Atlanta Fed estimate, and what we were looking at with real data is that it had plummeted. We saw Q1 trending pretty good, and all of a sudden it plummeted. We saw at least some early estimates of contraction, maybe as large as 2.8%. And a lot of folks were scratching their head trying to figure out what was going on. Right now, today, without adjustments, we're still trending at about a 1.8% contraction for Q1 GDP. But there's big footnotes. The first big footnote is that gold, the imports of gold, have surged to levels that we haven't seen before. And again, a lot of it is the risk component, but you see like at Costco, you see that the sale of little gold chips are breaking records for Costco and generating significant income. And when you import an ounce of gold, the price of gold is so high that it makes up for so many other products. You can very quickly, importing a lot of gold, you can very quickly sway and create the import-export balance. You can throw it way off balance and way off kilter. And so what that does is anytime we have imports surge, it pulls away from GDP. It depresses GDP. So the Federal Reserve has gone in and tried to adjust for the impact of gold. And right now they're showing that with that adjustment in gold, that we would be running about 2 to 3, maybe 0.5% of growth in Q1. But what they don't strip out is the impact of like tariffs and early import activity as companies tried to get ahead of tariff risk. And when they ordered, back in December, they were also trying to get ahead of a port strike risk. So you had a lot of extra growth there, or growth in imports that affected GDP overall. What I'm trying to get to is this. Okay, and I should have just said this right up front. when we peel back all the layers of the onion and you look at real underlying fundamentals for the economy, the consumer is still very strong. Consumer is still spending. That shows up in Q1 GDP. We had a good, strong consumer, which is 70 to 75% of normal GDP. In Q4, it ran as high as 82% of GDP. So with a strong consumer, we don't have a lot of worries of overall recession. We also don't see any changes in the job market. We don't see the unemployment rate surging yet. There's some ways that Doge has kind of masked that a little bit, so we're concerned there maybe, but don't see big concerns on the labor front at the moment. Wages are still growing. Inflation is still largely in check for now. We'll see what happens when all the tariff activity finishes. Um, and we're seeing corporations still spending and investing, and we see private residential expansion. So the underpinnings of the economy look pretty good still for Q1, which means that we're probably not at recession risk right now. Now, we don't like what we see in the stock market. That has a big impact on RV sales. And that's one of the big things that I'm watching is what happens to the stock market. Does it rebound the minute we get past all the tariff risk? And if that's the case, then I think you'll see some consumers are just sitting on the sidelines today, jump back in the market. We know that growth on Wall Street led to about $1 trillion in brand new stock market wealth, which led to about between 200 and 300 billion dollars in new consumer spending in 2023 and 2024. So that has a huge impact. I just don't think we can understate it enough or overstate it enough. There we go. I got it right. Um, Annual sales forecast right now for the industry, though, running about 3 to 5%. Wholesale shipments, we know the inbound side of things and inventory building side of things still looks like they're going to be running somewhere between 6.5 and 7.5%. So we are still thinking that despite what looks like some sounds like some inventory overstocks right now, you're going to kind of continue to see that as long as the wholesale shipment side continues to grow at that rate. Rentals right now are a little bit sluggish. Historically, we've run a little bit hotter than 2.5%. But again, I think some of this will change as we start to see the impact of a lot of companies reshoring. We've talked about that before, but I think we're going to see that accelerate because a lot of the Trump administration policies, it's what literally they're trying to do, is trying to boost U.S. manufacturing activity. So as you start to see shovel-ready projects start, then you start to see RV rentals tick up, and we start to see more of that migrant labor force really get engaged and getting on site in a lot of these areas. The same thing will happen in the energy market, and we're starting to see a lot of mobile workers in the energy sector, and all of them are pulling fifth wheels or maybe even doing some motorized units. But that's kind of what we're looking at. So I think this will increase as we move deeper into the year and get better. There's a lot of demand right now. It's kind of interesting, kind of a pop culture thing, but a lot of demand for these sub $20,000 units. And they think that's going to increase all year long. I know I get out personally and I go watch a lot of YouTube videos to look and see what younger generations are doing. And there's such an interest right now in just, like single overnight camping. But a lot of them are doing pull behinds, and a lot of them are really into the gadgets and the electronics and a lot of the digital stuff that they're putting on them now. And so anything sub 20,000 unit, we know is going to be good demand for that. They also think that about 35% of Gen Zers would be interested in it because they're seeing it on social media, and social media is making it cool. Kind of an old term for a new trend. But they would be interested in it if they knew more about it, could understand more about it, and if it was affordable for them to get into it. So that's a big opportunity, I think, for the market moving forward. The average age, I think, is still somewhere around 49. I think I've seen some data showing it a little bit younger, maybe even in the 30s. But when you look at the total industry as a whole, average age is about 49 years of age. So kind of interesting. So the tariff risk is interesting also because it's going to be complex. So the way the rules are written right now, a tariff on like the USMCA markets, you've heard about the 25% tariffs on Canada and Mexico. Some products underneath the USMCA agreement are excluded from tariffs. So part of the agreement is some products should get that exclusion. So what they're going to be watching for is the percentage of those components that are using foreign parts beyond Mexico or Canada. So if an item comes in from Mexico to the United States and only 10% of the cost of that RV or that unit or that component is using Chinese or South Korean or Japanese parts, only that part of the product price would be subject to a 25% tariff. So because of that, they think that maybe the average RV cost could rise anywhere from five to about $15,000, depending on where it's sourced and depending on what that percent of those components look like. There's not enough visibility into that right now for us to have a really good, solid estimate on what that risk is, but that's kind of what it feels like. Now, repair costs will go up more because a lot of those parts are sourced directly. And so until those supply chains can change, they could feel the full brunt of the full tariff impact. So anywhere from 10 to 25%, depending on the source origin and what the final tariffs look like and how reciprocal tariffs work. There's a lot of that coming. The last little bit that I had for you was that there's probably going to be a little bit of interest rate relief coming. It's starting in the 10-year treasuries. We see the 10-year longer term borrowing starting to come down. So some of the longer term RV markets, some of the higher dollar value ones that have longer loans on them, they could benefit from a dropping 10-year treasury rate. The other side of the market, the shorter term rates, from anywhere from 3 to 6 to 7 years, those are going to be impacted more by the Fed funds rate. And it sounds like the Federal Reserve is probably into a longer holding period until they really see what's going to happen with inflation. So we thought we were going to get two more quarter point cuts this year, but it looks like we may not. We may see that extended, and we may see maybe the first cuts coming in sometime toward the second half of the year. It just depends on what happens with GDP growth and what happens on the jobs front versus what happens on obviously the inflation front. And the Fed's fighting both of those. So we'll see what happens, but I think there could be a lot to watch there. Okay, so the forecast from last month did not change necessarily. We are seeing some revisions. Some folks are a little bit weaker with GDP. I see some of the big banks have kind of moved growth down to about 1.7%, but the unemployment rate literally stays fairly unchanged. Now there is some masking. So some of the Doge layoffs, some of those come with severance packages that extend payments to those workers out through September. So they don't show up in the US unemployment rolls, but you're talking about less than 250,000 people. I know it sounds like a lot, and it is a lot, but we have over 7.8 million jobs open in the United States at the moment. And when you look at the total workforce, 250,000 is really a drop in the bucket. And on a good month in the United States, we can create 250,000 new jobs. So yeah, we'll see what happens to the unemployment rate, but they're expecting it to maybe inch up a little bit, over the course of the year, but nothing too significant. Okay, so that's what I have for you right now. Again, a lot of moving parts, and we'll see what happens with the tariff impact. But I think there are a lot of things that could actually spur RV growth. Back to those government workers, and I didn't talk a lot about this, but a lot of them that have their hands free and they're still getting paid through September if they were close to retirement, what a better time for them to get out and actually go do something, right? To go jump into and buy an RV and go, visit the country. I think you could see a lot of that. You could see a lot of rental income go up because of that. And then again, as we said, a lot of transient workers, we think those will increase, and you could see some sales based on that. Now, I've said a lot of this stuff. It sounds a little optimistic, and it is. There's a lot of risk out there, and that's just being honest. There's still a lot of risk, and we've got to work through that. But overall, the data looks like it's holding its own and doesn't look too dramatic. So we'll give you an update next month and kind of see where we are at that time, and we'll know more about tariffs and the reciprocal tariffs and what that all looks like as well. So hope you have a great month, and we'll see you soon.